On the morning of June 5th, $1.3 trillion evaporated from the U.S. stock market before most finished their morning coffee. There was no war, there was no banking collapse, yet 48 hours before the sell-off, billionaire investor Ray Dalio stood in front of a camera and mapped out exactly how this wipeout would happen. His argument was simple. The underlying technology can be a complete success, and you can still lose your shirt buying the stock. Many investors assume that because artificial intelligence is a legitimate technical breakthrough, buying shares in the companies building it is a guaranteed win. But markets price companies based on expectations of future cash flow, not just technical utility. This confusion between the reality of data centers and the fantasy of stock valuations is what set the trap. Wall Street failed to separate the long-term potential of the software from the immediate price of the shares. The sequence began at 8:30 in the morning. A hotter-than-expected May jobs report hit the wire. Strong employment gave the Federal Reserve every reason to hold interest rates high, keeping the cost of borrowing expensive. Higher rates directly crush the future valuations of tech stocks. When money is no longer cheap, investors stop paying premium prices for companies that promise returns 5 or 10 years down the road. Then came the second hit. Chipmaker Broadcom released its earnings. While the company was growing, their revenue guidance missed expectations, a minor discrepancy for their scale. But in a fragile market, that minor miss triggered an absolute avalanche of selling across the semiconductor sector. Nvidia lost $300 billion of market cap in a single session. Micron fell 13%, and AMD dropped double digits. This massive wealth erosion illustrates the danger of current market positioning. A sector priced for absolute perfection simply collided with a slightly imperfect reality. To understand why the market is so sensitive, you have to look at the arms race between tech giants, specifically the battle between OpenAI and Anthropic to build frontier models. Training these models requires immense physical resources. Google, Microsoft, Meta, and Amazon are projected to spend over $700 billion on data centers and specialized chips by 2026. This chart shows the impossible math facing these companies. The steeply climbing curve represents massive capital expenditure on AI infrastructure. The flattened line below shows actual revenue. The gap represents hundreds of billions in unrecovered costs. To sustain this deficit, companies need unwavering investor confidence. Any sign that the revenue line isn't going to catch up quickly acts as a fatal blow to the stock price. Investor anxiety is now focused on the high stakes of this build-out. There is a growing realization that billions are being poured into infrastructure that may fail to generate a meaningful profit in the near term. This risk extends into a hidden corner of the economy, the $1.8 trillion private credit market. These are shadow lenders operating outside the traditional banking system. For years, these lenders have heavily financed software and tech services companies that often lack the cash flow to borrow from conventional banks. Generative AI is now creating a direct threat to these businesses. The technology is rapidly automating the coding, testing, and support roles that these software firms rely on to justify their fees. This chart tracks the contagion path. AI automation replaces human labor, which erodes the revenue of legacy software firms. As these companies struggle to pay their debts, they default, inflicting losses on the private credit funds that backed them. The broader market risk lies in a fragile, highly leveraged house of corporate debt that AI is actively destabilizing. The sudden flight from the U.S. tech sector forced global capital to find new homes. Much of that money sought refuge in Economy B, specifically India, which emerged as a primary safe haven during the June 5th volatility. India's growth is insulated from the AI bubble because it is driven by tangible realities. It relies on massive domestic consumption, highway construction, and a robust banking sector. Ironically, India's lack of dominance in the AI development race is exactly what attracts terrified investors. Its markets offer a way to participate in global growth without being exposed to tech sector speculation. When speculative bubbles begin to leak, smart money flees the abstract promises of the future for the physical infrastructure of the present. This mirrors the year 2000 dot-com bubble. Back then, the hype surrounding internet infrastructure was identical to the frenzy we see in AI today. The internet eventually changed the world, but the overvalued companies that built it still went completely bankrupt. Investors who bet on the technology were right about the future, but wrong about the price. This is the tech paradox. Artificial intelligence will undoubtedly change global productivity, but current stock valuations are detached from that reality. The $1.3 trillion shock was a stress test. As the market resets, you have to question whether you are investing in a viable tool for tomorrow or just buying into the financial bubble that paid to build it.